In the complex world of international energy politics, few decisions carry as much weight as those involving oil sanctions. And when the most powerful nation on Earth suddenly reverses course on a policy it had aggressively enforced for years, the entire global market takes notice. Just weeks ago, the Trump administration had drawn what appeared to be an unbreakable red line. The message was crystal clear. Any nation, any company, any individual caught purchasing Iranian oil or petrochemical products would face the full force of American economic might. Secondary sanctions would follow, a financial weapon that could sever business ties with the United States entirely. The warning was particularly pointed toward one nation, China, the world's largest energy importer and Iran's most significant oil customer. But then, on June 24th, everything changed. In a post that caught even his own government officials off guard, President Trump announced on Truth Social that China could resume purchasing Iranian oil, provided that Israel and Iran reached a ceasefire agreement. The statement didn't stop there. Trump went further, expressing his hope that China would simultaneously increase its purchases of American crude oil. The reversal was stunning. Government insiders were blindsided, oil traders scrambled to understand the implications, and analysts worldwide asked the same questions. Why this dramatic shift? What calculations led to this complete policy turnaround? And perhaps most intriguingly, why is the United States now essentially pleading with China to buy American oil? To understand this remarkable development, we need to examine the intricate web of energy dependencies, geopolitical pressures, and economic realities that connect Washington, Beijing, and Tehran in ways that transcend simple politics. Just weeks ago, the Trump administration had drawn what appeared to be an unbreakable red line. The message was crystal clear. Any nation, any company, any individual caught purchasing Iranian oil or petrochemical products would face the full force of American economic might. Secondary sanctions would follow, a financial weapon that could sever business ties with the United States entirely. The warning was particularly pointed toward one nation, China, the world's largest energy importer and Iran's most significant oil customer. But then, on June 24th, everything changed. In a post that caught even his own government officials off guard, President Trump announced on Truth Social that China could resume purchasing Iranian oil, provided that Israel and Iran reached a ceasefire agreement. The statement didn't stop there. Trump went further, expressing his hope that China would simultaneously increase its purchases of American crude oil. The reversal was stunning. Government insiders were blindsided. Oil traders scrambled to understand the implications. And analysts worldwide asked the same questions. Why this dramatic shift? What calculations led to this complete policy turnaround? And perhaps most intriguingly, why is the United States now essentially pleading with China to buy American oil? China's unquenchable thirst for energy. China's economic miracle over the past 4 decades has been powered by an ever-growing appetite for energy. Today, the country consumes approximately 750 million tons of oil annually, a staggering figure that reflects the needs of the world's second-largest economy, its massive manufacturing sector, and a population of over 1.4 billion people. But here's the critical challenge. China simply cannot produce enough oil domestically to meet this enormous demand. As of 2024, Chinese oil fields extracted roughly 200 million tons per year, less than 1/3 of what the nation actually needs. The remaining 550 million tons must come from abroad, making China deeply dependent on international oil markets and foreign suppliers. This dependency isn't a weakness in isolation. It's a strategic vulnerability that shapes Chinese foreign policy, drives massive infrastructure investments like the Belt and Road Initiative, and influences relationships with oil-producing nations across the Middle East, Africa, Russia, and Latin America. Enter Iran, a country sitting atop some of the world's richest petroleum reserves. The Iranian connection. Cheap oil and strategic partnership. Iran possesses approximately 158 billion barrels of proven oil reserves, ranking third globally behind only Venezuela and Saudi Arabia. For Chinese buyers, Iranian crude offers something increasingly rare in today's volatile energy markets, a significant price advantage. Iranian oil typically sells for $10 to $15 less per barrel than comparable grades on the international market. When global oil prices hover around $80 to $100 per barrel, this discount represents substantial savings. For a country importing hundreds of millions of tons annually, these savings translate into billions of dollars, money that can be redirected toward economic development, technological advancement, or strategic reserves. According to first-quarter data from 2025, Iran exported approximately 142 million tons of oil, with China accounting for a remarkable 63% of that total. Put simply, for every 10 barrels of Iranian crude leaving port, 6 were destined for Chinese refineries. This relationship has made China Iran's economic lifeline and given Beijing significant leverage in a region traditionally dominated by American influence. But the relationship extends far beyond simple buyer-seller transactions. China has invested heavily in Iran's energy infrastructure, treating the relationship as a long-term strategic partnership rather than a mere commercial arrangement. In January 2009, China National Petroleum Corporation signed a landmark cooperation agreement worth $1.76 billion to jointly develop the North Azadigan oil field in southwestern Iran, near the Iraqi border. This field spans approximately 1,400 square kilometers and contains an estimated 42 billion barrels of crude oil, making it one of the largest onshore oil fields discovered anywhere in the world over the past 3 decades. 8 years later, in 2017, China and Iran launched an even more ambitious project, a $3 billion renovation of the Abadan refinery. Upon completion, this facility gained the capacity to process 210,000 barrels of crude oil daily, producing gasoline and diesel meeting Euro 5 environmental standards, a significant upgrade for Iran's domestic refining capabilities. These investments represent something more profound than profit-seeking. Through years of sustained cooperation, China has helped build a complete oil industry value chain in Iran, covering everything from extraction and transportation to refining and distribution. For Beijing, this reduces dependence on other suppliers and creates strategic redundancy in its energy security architecture. But for Washington, watching this partnership flourish has been nothing short of alarming. America's pressure campaign, sanctions, seizures, and strategic containment. From the American perspective, China's deepening energy relationship with Iran represents a direct challenge to United States strategic interests in the Middle East and beyond. The logic is straightforward. Oil revenues are the foundation of Iran's economy. Every dollar Iran earns from oil sales strengthens a government that Washington views as a destabilizing force in the region, a supporter of militant groups, a nuclear proliferation risk, and an adversary to American allies like Israel and Saudi Arabia. If China continues purchasing Iranian oil, it effectively undermines American sanctions policy, provides Tehran with economic breathing room, and demonstrates that United States pressure can be circumvented by simply doing business with alternative partners. Washington's response has been aggressive and multifaceted. In April 2023, Iran shipped approximately 1 million barrels of crude oil, valued at roughly $80 million, aboard the Suez Rajan, a vessel operated by Greece's Imperial Navigation Company. The destination was China. But as the tanker passed through the Strait of Malacca, one of the world's most critical maritime choke points, United States authorities seized the vessel without warning. The official justification? American officials claimed the Iranian Revolutionary Guard Corps had escorted the shipment, thereby violating United States sanctions against Iran. The outcome was swift and decisive. The United States confiscated the vessel, seized the cargo, and later sold the $80 million worth of crude oil at auction. The incident was more than a commercial dispute. It was a demonstration of American extraterritorial reach and willingness to enforce its sanctions even in international waters. Iran protested vehemently through Swiss diplomatic channels. Switzerland represents Iranian interests in Washington given the absence of formal diplomatic relations, but the objections were dismissed. Tehran responded with its own show of force, intercepting two Greek-owned vessels near the Persian Gulf and issuing a stark warning. Any attempt to unload the Suez region's cargo would trigger further retaliation. But Washington proceeded regardless, and the oil was sold. The United States didn't stop there. Financial pressure followed. Imperial Navigation Company faced threats of criminal prosecution. What would have been the first criminal case involving illegal transportation of embargoed Iranian oil? Faced with potential legal jeopardy, the company's subsidiary paid a $2.5 million fine and complied with American demands. By February 2025, the Trump administration had escalated dramatically, launching what it called a maximum pressure campaign designed to reduce Iranian oil exports from approximately 1.5 to 1.6 million barrels per day down to less than 100,000 barrels daily, a reduction exceeding 90%. In March, the United States Treasury Department added numerous companies, individuals, and vessels from Iran, India, and China to its specially designated nationals list, a designation that effectively freezes assets and prohibits American citizens and companies from doing business with listed entities. 4 Chinese companies and their associated vessels were included. April brought expanded sanctions targeting additional Chinese firms involved in maritime transshipment operations that helped move Iranian oil to international markets. The cumulative effect was significant. Iranian oil shipments to China began declining, with industry analysts projecting drops exceeding 20%. Many observers believed that large-scale oil trade between the two nations would become virtually impossible to sustain. And then came Trump's surprising reversal. The sudden policy shift. What changed? Trump's June 24th announcement that China could continue purchasing Iranian oil, contingent on an Israeli-Iranian ceasefire, shocked oil markets and government officials alike. The statement seemed to contradict years of consistent policy aimed at economically isolating Tehran. So what happened? What calculations drove this apparent about-face? The answer lies in a combination of factors, beginning with America's own economic interests. The United States isn't just a major oil consumer, it's also one of the world's largest producers. The American petroleum industry generates over $300 billion in annual revenue, supporting millions of jobs and contributing significantly to the domestic economy. Exports are a crucial component of this industry, and China has historically been one of the most important overseas customers. In 2016, China imported nearly 8 million barrels of American crude oil, representing roughly 25% of total United States oil exports. China was, at that time, a cornerstone customer for American energy producers. But the relationship deteriorated sharply during Trump's first presidency and continued declining through subsequent years. Tariffs, technology export restrictions, semiconductor bans, and various other policy measures strained bilateral relations across multiple sectors. By March 2025, American crude oil exports to China had plummeted to just 3 million barrels. Then, starting in April, Chinese purchases stopped entirely. Not a single drop of American crude oil was purchased for 2 consecutive months. The result? Approximately 18 million barrels of United States oil sat unsold, with American shale producers absorbing losses estimated at over $10 billion. This wasn't just disappointing, it was economically painful. American oil producers, particularly smaller independent companies operating in shale formations across Texas, North Dakota, and other states, depend on steady export demand to maintain profitability. When a customer representing a quarter of your export market vanishes overnight, the consequences ripple through the entire industry. Washington initially believed that cutting off China's access to Iranian oil would force Beijing to return to American suppliers. The logic seemed sound. If China couldn't buy from Iran and needed to maintain its energy security, it would have no choice but to purchase from alternative sources, including the United States. But this calculation overlooked a fundamental reality. China has options. China's energy diversification, more than one supplier. Beijing's response to American pressure demonstrated sophisticated energy security planning. Rather than capitulating to American demands, China simply diversified its supplier base. Saudi Arabia emerged as a key alternative. As the world's largest oil exporter with production capacity exceeding 12 million barrels daily, Saudi Arabia could easily absorb increased Chinese demand. The relationship between Beijing and Riyadh had been strengthening for years, with China becoming Saudi Arabia's largest trading partner and a major investor in Saudi economic diversification projects. Russia also expanded its role as a Chinese oil supplier, particularly after Western sanctions following the Ukraine conflict created opportunities for discounted Russian crude. Other suppliers from the Middle East, Africa, and Latin America contributed to China's diversified import portfolio. The strategic lesson was clear. In today's globalized energy markets, attempting to coerce a major buyer by cutting off a single supplier is unlikely to succeed when numerous alternatives exist. China demonstrated that economic dependencies run in multiple directions, and the nation holding the sanctions lever isn't always the one with greater leverage. The Strait of Hormuz, a geopolitical choke point. Beyond the commercial calculations, another factor likely influenced Trump's policy shift: the threat to one of the world's most critical maritime routes. In June 2025, Iran issued a stark warning that it might blockade the Strait of Hormuz, a narrow waterway between Oman and Iran connecting the Gulf of Oman and the Persian Gulf. This threat emerged in response to reported American incursions into Iranian airspace and attacks on uranium enrichment facilities. The strategic significance of the Strait of Hormuz cannot be overstated. Approximately 20% of the world's oil and natural gas flows through this passage. Daily crude oil shipments exceed 20 million barrels, and roughly 1/5 of global liquefied natural gas transits these waters. Oil exports from Saudi Arabia, the United Arab Emirates, Kuwait, and other Gulf states all depend on this route. A blockade of the Strait of Hormuz would trigger immediate global consequences. Research institutions estimate that international oil prices would spike by at least 25% within days, potentially more if the closure persisted. For the United States, despite being a net oil exporter, such a price shock would drive domestic fuel costs higher, accelerate inflation, and potentially tip the economy toward recession. Beyond economics, a closure would represent a direct challenge to American military power in the region and could escalate into direct military conflict, a scenario with unpredictable and potentially catastrophic consequences. Trump's sudden willingness to allow Chinese purchases of Iranian oil might represent a strategic de-escalation, an attempt to reduce tensions before they spiral into a crisis that could disrupt global energy markets and draw the United States into yet another Middle Eastern conflict. The calculated gamble. Why now? Analyzing Trump's reversal reveals a leader attempting to navigate competing pressures: domestic economic interests, geopolitical stability, and strategic positioning against China, all while maintaining his administration's reputation for unpredictability. By permitting Chinese purchases of Iranian oil contingent on an Israeli-Iranian ceasefire, Trump accomplishes several objectives simultaneously. First, he provides relief to American oil producers desperate to regain the Chinese market. By publicly expressing hope that China will increase purchases of American crude, he signals to domestic energy companies that their concerns are being addressed. Second, he creates diplomatic space for de-escalation in the Middle East. By linking Iranian oil sales to a ceasefire, Trump positions himself as a peacemaker while maintaining pressure on Tehran to moderate its regional behavior. Third, he demonstrates to China that engagement remains possible despite ongoing tensions across multiple policy areas. This could create openings for negotiation on other contentious issues, from trade and technology to Taiwan and territorial disputes in the South China Sea. However, anyone following Trump's political career knows that consistency isn't his hallmark. He's built a reputation on unpredictability, sudden policy reversals, and willingness to abandon previously stated positions when circumstances change or political advantage demands it. Relaxing restrictions on Iranian oil today doesn't guarantee they'll remain relaxed tomorrow. If tensions flare in the Middle East, if domestic political pressure intensifies, or if Trump calculates that renewed sanctions serve his interests better, the restrictions could return as quickly as they were lifted. This uncertainty creates its own challenges. Chinese companies making long-term investment decisions need policy stability. Iranian planners developing their petroleum sector require confidence that export markets will remain accessible. American oil producers seeking to rebuild relationships with Chinese buyers need assurance that today's opening won't become tomorrow's closure. The broader implications: energy, power, and strategic competition. This entire episode reveals fundamental truths about contemporary international relations and the global energy system that will shape the coming decades. First, energy remains deeply intertwined with geopolitical power. Access to affordable, reliable energy supplies is foundational to economic prosperity and national security. Nations lacking domestic resources must navigate complex international relationships, manage multiple supplier dependencies, and constantly balance economic efficiency against strategic vulnerability. Second, sanctions, while powerful, have limits. When a sanctioned nation has buyers willing to maintain commercial relationships despite American pressure, the effectiveness of sanctions diminishes. China's willingness to continue purchasing Iranian oil, even under threat of secondary sanctions, demonstrates that American economic power, while substantial, isn't omnipotent. Third, the global energy market is increasingly multipolar. The days when a handful of Western oil companies and their government backers could dictate terms to producing nations have largely ended. China, India, and other major Asian consumers now wield enormous market power. Producing nations have options their predecessors lacked. This dispersion of power creates a more complex, fluid system where traditional approaches to energy diplomacy often prove insufficient. Fourth, economic interdependence cuts in multiple directions. The United States discovered that attempting to isolate Iran economically had consequences for American energy producers when China simply stopped buying American oil. Beijing learned that diversifying suppliers provides strategic flexibility. Tehran recognized that having a reliable customer provides economic resilience against Western pressure. Looking forward, an uncertain future. As we move forward, several questions remain unanswered. Will the hoped-for Israeli-Iranian ceasefire materialize? And if so, will it hold? Will China actually increase purchases of American crude oil, or will the commercial relationship remain strained by broader geopolitical tensions? Will Trump maintain this more conciliatory approach, or will domestic political pressures or international developments trigger another reversal? What seems certain is that energy will remain central to great power competition throughout the 21st century. As the world gradually transitions toward renewable energy sources, a process that will take decades, oil will continue serving as the lifeblood of industrial economies. Control over supply, influence over pricing, and access to markets will remain sources of power and points of conflict. The United States, China, and Iran, three nations with vastly different political systems, cultural traditions, and strategic interests, find themselves locked in a complex dance where energy provides both connection and conflict. Today's accommodation might become tomorrow's confrontation. Current partners might become future adversaries. Policies presented as permanent might prove temporary. For observers trying to understand international relations in this era, the story of Trump's Iranian oil reversal offers valuable lessons. It demonstrates how economic realities can override ideological commitments, how even superpowers must sometimes compromise when facing determined resistance, and how the pursuit of domestic political and economic goals can reshape international policy in unexpected ways. The game continues, with billions of dollars, millions of jobs, and fundamental questions of energy security hanging in the balance. China seeks reliable, affordable energy to power its economy. Iran needs oil revenue to sustain its government and population. The United States wants to maintain influence over global energy markets while supporting its domestic industry. Each pursues its interests through a combination of market actions, diplomatic engagement, and, when necessary, coercive measures. In this intricate contest, today's victory might be tomorrow's setback. Today's friend might be tomorrow's rival, and today's policy might be tomorrow's footnote. What remains constant is the centrality of energy to power, prosperity, and international politics, a reality that will continue shaping our world for decades to come. The question isn't whether these dynamics will continue. They will. The question is how effectively each nation navigates this complex terrain, balancing economic interests against strategic imperatives, managing relationships with competitors and partners alike, and adapting to an international system where power is increasingly distributed rather than concentrated. For now, China can continue buying Iranian oil, American producers hope to regain Chinese customers, and Trump has demonstrated once again that in his approach to international affairs, the only constant is change itself. Whether this shift proves to be strategic wisdom or tactical expediency remains to be seen. But in the high-stakes world of global energy politics, the decision will have consequences that ripple far beyond Washington, Beijing, and Tehran. Consequences that will affect markets, policies, and lives across the entire planet.